Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Bloom Energy, Why I'm Waiting for a Price Correction. This article was written by Analysis Fundamental. Summary. Bloom Energy holds a tech moat in on-site power for data centers, driving strong demand and a 300% stock surge. BE's transition to an asset-light, recurring revenue model is catalyzed by a $5 billion Brookfield partnership, reducing CapEx needs and boosting financial flexibility. Despite positive operating cash flow and improved margins, BE remains overvalued at 127 times PE, justifying a hold rating until a price correction. Key risks include AI infrastructure demand volatility and regulatory shifts affecting the 30% investment tax credit supporting BE's fuel cell economics. Investment thesis. The present article focuses on Bloom Energy Corporation's leading position as an on-site power provider for data centers, its transitioning toward a more recurring revenue model, and how investors should approach the stock given its overvalued valuation and risks. Bloom Energy's stock has increased by over 300% in a year, mainly driven by the massive potential demand for on-site power solutions for data centers. Combined with strong revenue growth and marginal profitability, the company has started to show financial discipline and, in my opinion, has a tech moat compared to its main competitor, Plug Power, Nasdaq PLUG. However, its overvaluation due to the hype around AI leads me to rate the stock as hold, despite its growth potential and strong momentum. BE's financing discipline. BE has remained unprofitable for the last few years, mainly because of the high cost of revenue and operating expenses. And only in FY24 did the company report positive operating income, but net income was still negative. Currently, BE appears close to break-even point in terms of net income. With slightly positive profitability on a TTM basis, let's examine its finances more carefully. My quarterly analysis shows strong revenue growth of 57.1% year over year, with improvement across all profit margins. Still, the cost of revenue is above 70% for Q3 25, but notably down from 76% in Q3 24. Operating expenses are moderately high, accounting for 27.7% of revenue in Q3 25, significantly lower than 76% in Q3 24. Also, the company reported positive OCF for the first time since FY15, a milestone that was also reflected in its FCF margin of 1% in Q3 25. The positive FCF is a crucial factor for the company's liquidity position, as well as for its growth potential, considering its high CapEx requirements. BE has total debt of $1.5 billion in Q3 25, with the majority being long-term and only $595 million in cash. Therefore, BE's ability to generate strong cash flows will provide finance space to meet its obligations. Also, the company's recent partnership with Brookfield Asset Management, BAM, signals a reduced need for CapEx and capital from BE. Specifically, BAM will finance BE for the construction and installation of fuel cells for hyperscalers clients and generally for AI data centers, without BE needing to use its own capital. BE will have recurring revenue from this business model through power purchase agreements, PPAs, under which it will sell the produced electricity by its fuel cell tech. As the company's management stated, on top of that, if there are Bloom-sourced deals that require financing, so we can offer a customer a PPA, they are willing to step in and be the financier for that. This is all not, and they have made it very clear that this $5 billion investment is an inaugural investment. Brookfield will also finance Bloom-sourced AI opportunities. We have already completed projects, and Brookfield plans to announce a Bloom-powered European AI inference data center project by the end of the year. So, in my view, the $5 billion partnership with BAM was just the beginning. But the most important thing is that BE is shifting toward a more asset-light of its business model, with more stable and more easily forecasted recurring revenues. Furthermore, BE has strong financial leverage to support its expansion and the AI demand for its fuel cell technology, as reflected by both interest coverage and debt-to-equity ratios over the years. In recent quarters, the company seems to be reducing its leverage risk, and given the above partnership, I foresee even better leverage ratios in the future. In summary, the company seems to have demonstrated financial discipline in recent quarters. Also, BE's tech has strong demand, mainly from AI infrastructure projects, something that BAM has already recognized and taken advantage of through a win-win initial partnership of $5 billion. Brookfield deal based on Bloom's tech moat. As the company's co-founder and CEO, Kees Radar, stated, as we have previously announced, we are doubling our capacity to 2 gigawatts by December 2026, which will support about 4 times our 2025 revenue. Investors should expect impressive revenue growth at the end of FY26. But why does Bloom see such strong demand for its fuel cell technology? And why does BAM support the company by financing these projects? The answer relies on the company's advanced technology. Based on BE's report, Bloom Energy's solid oxide fuel cell (SOFC) platform provides a non-combustion pathway to convert fuels directly to electricity without combustion. The energy server is fuel flexible and can generate energy using natural gas, blended hydrogen, biogas, or hydrogen. It is designed in a modular concept that is ideal for on-site distributed power generation, operating 24/7, and supporting the power demand in grid parallel or a microgrid architecture. In short, BE's fuel cell technology can use various fuels as input in order to generate stable 24/7 power at low cost and in a modular concept. This is suitable for data centers that need massive power, and BE's tech offers a solution both off-grid and on-site. The terms off-grid and on-site are both key points of its tech moat. On-site means that BE's fuel cell can be built close to the data centers, so the client does not need to spend money to connect fuel cells to the data centers with massive cables. In contrast, BE's tech offers a solution where the generated electricity is connected directly to the data center without the need to connect to the public electricity system off-grid. In my view, one more key advantage for BE mentioned by the company's CEO. Back in August, we announced our first deal to power an AI factory with Oracle. We have fulfilled our delivery ahead of schedule. We promised to deliver in 90 days, and we delivered in 55 days. In my view, hyperscalers will prefer a modular and quick solution to support their need for power, compared to more time-consuming solutions such as quantum energy. Once the data center has been built, it needs immediate power to operate. I cannot see why hyperscalers, and not only they, would not prefer fuel cell tech. In addition, BE's fuel cell can operate with various fuels and not only with hydrogen, like its peer Plug Power. This means that if a fuel becomes more expensive, BE can switch it with a less costly fuel and as a result, maintain its operating margin steady, regardless of fuel prices. In contrast, Plug has a high dependence on hydrogen price and demand. Given that, the hydrogen production is projected to stand at 37 million tons per year, MTPA, down from 49 MTPA by 2030 due to cancellations and project delays, will affect hydrogen prices. Therefore, Plug's revenue and profitability. So, in my opinion, Brookfield is investing in Bloom's tech moat and momentum through a win-win partnership. Bottom line, BE has a clear tech moat and is well-positioned to benefit from the increased demand due to data centers, something that NVIDIA's CEO clearly mentioned on CNBC. Data center self-generated power could move a lot faster than putting it on the grid, and we have to do that. However, investors need to take a position in a good company, but also at a good price. BE's PE of 127 compared to the sector's 21.44 signals a strongly overvalued stock. Bloom is projected to have impressive revenue growth in the coming years, and the FWD/PS ratio looks attractive. However, all the other valuation metrics indicate significant overvaluation. Let me explain my thoughts directly. In my view, valuation metrics do not always capture the full truth about a company's potential. At this moment, the metrics reflect the company's overvaluation. Consider that investors need to pay about 127 times BE's earnings, while its operating income is only slightly positive after many years of negative levels, which indicates that Bloom is still not clearly on a profitable path. Also, investors should take into consideration that Bloom's recent performance is driven mainly by data center growth, Any slowdown in AI infrastructure demand or delays in AI projects could have a direct impact on the company's performance and profitability. Furthermore, Bloom operates in a regulatory environment. Currently, Bloom is eligible for an investment tax credit, ITC, of 30% for fuel cell projects and has already benefited from this supportive regulation. However, any change in this environment would have a direct impact on the company's performance and may reduce demand for its company's solution. Based on Bloom's Q3 25 report on July 4, 2025, the One Big Beautiful Bill Act, the OBBBA, was enacted into law, and under new Section 48E, it restores the ITC at 30% for fuel cell property, without regard to emissions for projects beginning construction after December 31, 2025. The 30% tax credit is available at 100% through 2033, and then will be subject to a 3-year phase at 75%, 50%, and 0%. Under Section 48E, fuel cell property is not eligible for the additional domestic content or energy community credits, and our projects will be limited to a 30% ITC credit. Overall, I rate this stock as hold, but I suggest investors monitor BE stock. I believe the company has significant potential to outperform in the long term, but I suggest opening a position after a price correction in order to achieve maximum return with minimum risk. Its tech moat, combined with financial discipline and strong momentum, are the major drivers for further expansion. The risks that the company needs to deal with are unpredictable, as they stem from the industry and overall from the market economy, and not from competition or its business model, in my opinion. Therefore, if you are a long-term investor, be patient and wait for a price correction before opening a position in Bloom Energy. This article was written by Analysis.
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.